Welcome to Investors Insight, where today's topic is deposits versus loans. We hope that everyone had a great Thanksgiving. A lot going on this week. Before Trey talks about the new bank capital rules and interest rates, I'm going to cover housing. But Ty, give us an update on market performance in presidential election years. Obviously, politics is about to rev up here. And tell our viewers, give us an update on why it matters, what the market has historically done in previous election years.
Yeah, we're here at the end of November. We're about a year away from an election. And so I think it's important to, kind of forward look here. And as you can see in this chart, the S&P is reflected by the red line in all years, and then the blue line in presidential election years. And as you can see, in the first half of the year, we typically see kind of a pullback. That's when things start to ramp up. You start to see some challengers, kind of come across the board. Things start firming out a little bit, and then of course we have a little bit of a dip leading into the presidential election. While the presidential election year is not as good overall as every other year for the S&P, it's still a positive year, and I think that's important to note that we're going to see a lot of policy uncertainty. That's very common in year four for a president. And I think that's something that, a lot of people are going to be nervous about. But, if you see the bigger picture here, it is still a positive year for the markets. And then I want to point to this chart one more time as well. The S&P has not declined in a presidential re-election year since 1952. The only time it has declined since then were open election years. And so we do, of course, have a re-election year. And that's important to note. Hopefully that trend will stay true since 1952.
Yeah, we love the historical relevance and what the market has previously done in election years. No guarantees. I mean, there's always going to be volatility in the markets in presidential election years, but we love that historical relevance. Thanks, Ty. And then, Trey, there's some new banking capital rules that matter and their impact on interest rates. Talk about that.
Yeah, absolutely. Thanks, Bobby. The estimated monthly income from money market funds, that's a $24 billion monthly income tailwind for consumers. While that number is large, it pales in comparison to what would happen if banks started paying higher interest rates on deposits. So right now, money market is very appealing. We've done a lot of work with our clients in their excess cash to make sure it's getting the highest yield, which recently has been money markets. But $24 billion is a big number. However, if you look at the $8 trillion that is on bank balance sheets as deposits, if banks were paying 5% on deposits, that would be $400 billion in annual stimulus, an enormous payout to consumers. You can see on this chart the 10 largest financial institutions, and there's a lot of difference between these institutions. Massive institutions like J.P. Morgan with over $2 trillion in deposits. So this would be a very expensive thing for banks to pay through. But banks are also currently receiving higher payments from mortgage borrowers, and so they're receiving higher interest rates. So what's holding banks back is that there's been a lot of talk, especially since the middle of the summer, with the FDIC increasing reserve requirements, which would reduce the amount that banks are able to lend and increase the amount that banks have to keep on the balance sheet. It's not saying that's a good or bad thing, but it definitely tightens banks' willingness to pay out high amounts of money. The reason this is in today's news, even though most of these rule changes were announced in the summer, is that the current FDIC chairman is embroiled in a good bit of controversy that many on Wall Street are estimating may require him to step down before the end of the year. If he were to step down, that would completely change the makeup of the FDIC and could change what these rules are expected. So no one's really able to make a long-term decision on what banking reserve requirements will be until we know who the chairperson is going to be. And as long as that remains in flux, banks will likely hold everything close to the vest and keep what they're paying out tight. So something we're watching closely. It's impossible to predict because it's really outside of the norm of what usually moves banking markets.
Yeah, thanks, Trey. And it's one of those topics that's not being covered in the news, but it definitely is impactful for the market. So we'll continue to give an update there. And then with mortgage rates falling in recent weeks, we've been asked more and more about the housing market. So I want to give our viewers an update as we are nearing the end of 2023. And as you can see in this chart, U.S. housing starts and single unit permits rose slightly month over month in October. And that's despite the continued downward pressure from restrictive monetary policy. And so obviously limited supply of existing homes on the market, as those with low fixed rate mortgages stay put, is likely a key part of the story supporting the new permits and new housing starts. However, it is difficult to call a market that's kind of paralyzed in this way healthy. And so bottom line is recent housing and manufacturing data continue to show cracks in the U.S. economy, and there are cracks abroad as well, as numerous economies are reporting slowing real GDP and inflation. And at the end of the day, the U.S. consumer has been resilient thus far, and it remains our focus to judge which direction the business cycle goes from here as we head into the last month of the year and will quickly be in 2024, as Tom mentioned earlier, an election year. So a lot to look at here. If you have any questions on these topics we've discussed today, please reach out as we head into the last month of the year. Thanks for watching. Have a great week.